Okay, great. Good afternoon, everybody. Chuck Hughes here. Thanks, Tom, for the introduction. I've got a really exciting program for you today on trading weekly options. Some of you may not be familiar with weekly options. I've been trading weeklies since 2010, and there's a lot of great profit opportunities with weekly options. And I'm going to share some of those strategies with you today that have been working real well in real time. And I'll show you my actual trading results as of today for my weekly option strategies. So for those of you that are not familiar with weeklies, weekly options start trading on Thursday, and they expire the following Friday, so they have a life of 6 trading days. And one of the advantages of weekly options is that they allow you to start small. You can trade a portfolio of 5 options with a total of investment of $270, including commissions. And I'll show you an example of an actual portfolio that I traded a couple weeks ago with 5 options in it. Total cost for that portfolio was $270. So you can start small with weekly options. And weeklies give you 52 opportunities each year to profit. So this allows you to roll over your profits and compound your returns. And I'll show you some real-life examples of how I compounded my returns. And that's a big part of my weekly option program. So just as a background, I started out trading options with a $4,600 trading account, and since then I've made millions of dollars of profits trading options. And I think weekly options are the ideal investment for turning a small amount of money into a large amount of money. And we have 2 overall goals for trading weekly options. Number one, we trade them for price appreciation, and I'll show you a strategy we use for price appreciation. And another goal would be to generate income from the sale of option premium. And I have a strategy that allows us to generate income on a weekly basis from selling call options. So overall, I utilize 4 different strategies for trading weeklies. I use option purchases, covered calls, option spreads, and put selling. So as I mentioned, I've been investing in options for more than 27 years, and it's really the best way for small investors to get ahead. And as I mentioned, I started out with a $4,600 trading account, and within my first 2 years of when I started, I generated over $460,000 in profits, starting out with that small $4,600 trading account. And I'm showing copies of my tax returns for those first 2 years of trading, showing this $460,000 in profit. So it is possible to start out with a small amount and turn that into a large amount of money. And these two years, I was able to do that. So if you've lost money investing in stocks or mutual funds over the past 12 years, you're not alone. The S&P 500 index is actually trading below where it did 12 years ago. So over the past 5 years alone, we've had a global financial meltdown, severe recession, bear market, high unemployment, increased market volatility, and an uncertain economy. So this financial turmoil has made it very difficult for the average investor to realize a consistent return on their investment. So despite these difficult market conditions, my option strategies actually produced over $3.3 million in actual profits over the past 5 years. And I included copies of my brokerage statements showing this $3.3 million in profits in my Sure Thing Profit Secrets book. So despite these difficult market conditions, my option trading has been doing very well over the past 5 years. So again, you can start out small and build a small fortune with option trading. So let's talk about option purchases first. In the trade selection process, I use to select options to purchase. And the goal, of course, with your trade selection is to find the options with the best profit potential. So we use a simple two-step selection process. Step number one is we use MACD and the 50 and 100-day EMA trend following systems to determine the price trend of a stock or ETF. And in bull markets, if we have a price uptrend, we're going to be buying call options. And in bear markets, when we have a price downtrend, we're going to be purchasing put options. And in 2008, summer of 2008, my trend following system started to turn bearish. So I went short a lot of the global markets, and we did very well over the next 9 months, being short those global markets. We then reversed and went long in March of 2009, but options allow you to profit in down markets as well as up markets. And the second step in our trade selection process is we want to confirm the price trend. On any given day, there's a lot of stocks that are in a price uptrend, so my confirmation process allows us to narrow down that list of stocks to the stocks with the best profit opportunities. And I just wanted to mention, I've been using these same trend following strategies that I use for weekly options. I've been using those for more than 27 years to invest in options. So I use the same trend following systems I've been using the last 27 years to trade weeklies. And let's take a look at an actual option trade I made recently, and I'll walk you through the trade selection process so you can understand why I selected this option to trade. And I'm showing a daily price chart here for Microsoft, and the blue line here is the 50-day exponential moving average, and the red line is the 100-day EMA. Now, when the blue line, the 50-day, is above the 100-day, that stock is on a buy signal. So we can see here the 50-day EMA crossed above the 100-day EMA right around the beginning of the year. So Microsoft is on a buy signal once that 50-day is above the 100-day. And also, if you notice the price chart here, Microsoft is making a series of new 52-week highs. So that's one of the trend confirmation indicators we use to narrow down this list of stocks that are in a price uptrend. And I also like to use on-balance volume to confirm the price trend. And this is the on-balance volume line right here for Microsoft, and you can see that that's sloping up. So this upsloping on-balance volume line and the new series of 52-week highs confirm this price trend and confirm this buy signal when the 50-day EMA crossed above the 100-day EMA. And if you have an upsloping on-balance volume line, volume is heavier on days that the stock closes up, and volume is lighter on days the stock closes down. So this is an indication that the buying pressure for that stock is exceeding the selling pressure. And this volume flow in upsloping unbalanced volume line is an indicator that this price trend can be sustained because of this volume flow. And also, I discovered that stocks that are making a new 52-week high tend to continue their price uptrend. And a stock making a new 52-week high confirms the price uptrend and allows you to further narrow down that list of buy stocks to those stocks with the greatest profit potential. So plain and simple, a stock does not make that new 52-week high unless it's in a very powerful uptrend. So that's a real good trend confirmation indicator. So let's take a look at the option purchase I made for Microsoft based on my trade selection data. And this is a snapshot of one of my portfolio profit and loss figures for the week. And in this portfolio, I purchased the Microsoft February 18 30-strike calls at 52 cents. Now, I purchased those on February 14th, and I sold those 5 calls at 118 on February 17th for a 126% gain. So this was a weekly option. Buying the February 18th, that was a weekly option. So I held that trade for 4 days, closed it out on the 17th for 126% gain, and I purchased 5 calls at 52 cents. Now, an option normally covers 100 shares of stock. So if you purchase an option at 52 cents, the cost of that option would be $52. So I paid $52 for the option, sold them 4 days later at $118. So that translates to 126% gain in 4 days. So that's an example of an option purchase I made using my trade selection criteria.
Hey, Chuck, if you don't mind me interrupting, how many trades a week do you usually trade?
Yeah, that's a good question, Tom. I'm very active with weekly options. I usually average 20 to 30 trades a week. So I'm very active on Thursdays and Fridays, rolling over and closing out those weekly options. So there's a lot of opportunities when the options expire every Friday. Every Friday, you have a lot of opportunities throughout the year to trade. So it's a very active program for me. And let's take a look at the leverage that's provided by trading options, and we'll take a look at this Microsoft trade that I just took. And we saw where the Microsoft option trade produced a 126% return. Now, over that same 4-day time period, Microsoft stock increased 3.2%. So we can see that the option trade provided 39 to 1 leverage compared to the stock trade. So that's the reason why option trades can produce such a large return in a short period of time. It's because of the leverage that you get from trading options. And here's a graph of the option return, 126% option return versus the 3.2% return for the stock. So again, you can see there's a tremendous amount of leverage, and you get a much higher return trading options than trading stocks. And let's take a look at one more option trade I made recently, and this is for Home Depot. And we can see that the blue line, which is the 50-day EMA, is above the 100-day EMA. So Home Depot stock is on a buy, and we can see that it's been making a series of new 52-week highs. So this confirms the price uptrend, and we also have an upsloping on-balance volume line, further confirming the price trend. So I went ahead and bought 5 of the Home Depot February 18th 46-strike calls at 31 cents or $31 on February 14th, and I sold those 5 calls 4 days later for 50 cents. So that worked out to be a 61% return. So bought the options for $31, sold for $50, and that works out to 61% return. And that's after commissions, so the commissions are included in these trades. Now here's another snapshot of that the weekly options I traded that week, and for the 5 options I traded that week, here's the percent return here, and if you average that out, I had a weekly return that week of 82%. So the average return for these 5 options, Home Depot, Intel, Microsoft, Wells Fargo, and the financial ETF, I traded those 5 options that week and had an average return of 82% for that week. And the average cost of each contract was $54. So if you were to purchase one contract of these 5 options that week, the total cost for this whole portfolio, including commissions, was $270. So again, you can start small with weekly options. Now here's another week. This was the week I traded. These were the March 2nd weekly options, and I purchased these options on February 24th and closed those out either on March 1st, which was a Thursday, or I closed them out that Friday, March 2nd. So again, a 1-week time span, and that week I had an average return of 83%. Average cost for each option, if you were to trade one contract, was $59. Total cost of $236 to purchase this portfolio. So again, you can get into weekly options with a small amount of money, and there's an opportunity to turn that small amount of money into a large amount of money quickly. So a big part of the weekly option program is rolling over your expiring options with spread orders. And if a stock is still in a price uptrend and it still looks good, what I'll do is I'll close out the expiring option and I'll roll over into the next week's option. And if you use a spread order to do that, the spread order allows us to reduce the transaction cost, both the commission and the bid-ask spread for the options. And I'm displaying here an actual spread order I used to, this was to close out the Microsoft, the February 24th options, that was a weekly option, and then I bought the March 2nd option. So I'm closing out the February 24th options and buying the weekly March 2nd option. So I used a spread order, and of course I only paid 1 commission with this, and also it allowed me, I put the spread order in midway between the bid and ask for these options, so I was able to save money on the bid-ask spread when I closed these options out and bought to open the March 2nd options all in one order. So that allows you to reduce the transaction costs. And by rolling over options, it allows us to purchase more options and compound our returns. If we have a profit on an option, that allows us to buy additional options, and we can compound our returns. And in this particular rollover, it allowed me to buy the Microsoft, the March 2nd weekly option at no cost. So I was closing out the February 24th options at about $147 per option. Then I turned around and bought the March 2nd options for about $60 per option. So when I closed these options out, it paid for the March 2nd options, and I was able to purchase those at no cost, and of course I have no risk at that point. So rolling over options allows us, if you have a profit, allows us to compound our returns. And here's a snapshot of my weekly option advisory, the current open trade results. And This is for the option purchase portfolio. Currently have $126,000 in open trade profits with an average return of 203%. And in this portfolio, if you traded one contract, it would cost about $2,924 plus commissions to take each one of these trades. Now, let's talk about another strategy we use for generating weekly income. And we do this with covered calls. And a covered call trade is initiated by buying 100 shares of stock and selling the related call option. And you can do this with weekly options. In other words, if you buy 100 shares of stock, every week you can sell a call option against that stock and collect income. So I've been doing this actively, as I mentioned, since 2010. And this is a great strategy as far as the reward versus risk. I'm going to show you some actual examples of my returns selling covered calls with weekly options. And this strategy is actually less risk than owning stock. So this strategy has a great reward to risk ratio. And of course, when you sell an option, cash is immediately credited to your brokerage account. So let's say you sell an option with 4 points of premium, $400 in cash is immediately credited to your brokerage account. Now, this cash credit to your account reduces the cost basis of the stock and reduces the overall risk of the trade. And as I mentioned, this is actually less risk than owning a stock. So the great thing about weekly options is you get to do this 52 times a year. So every week I'm in there selling this option premium against my stock, and this has just been a great strategy. And if you roll over those weekly options each week, and I'll show you some examples of that, it allows you to compound your returns very quickly. So every week you're in there selling premium, and you get to keep that premium no matter what the price of the stock does. So that allows you, in turn, to trade more covered calls and allows you to compound your results.
Chuck, let's be real specific, because some of the attendees are asking about keeping the premium on your covered calls.
Yes.
So your break-even point is where you bought your stock. Selling the premium against it can be looked at it two ways: being able to lower your break-even point, or just being able to retain that premium if you're called away.
Yes, I'm gonna let's look at. I have a slide coming up here, and we'll go into that in detail.
Okay, great.
Yeah, there's three possibilities when you sell a weekly covered call. So we'll take a look at that. So just some basics with options. Options consist of time value and intrinsic value. And at-the-money options and out-of-the-money options consist of only time value. So at option expiration, options lose all time value. So if you're short an option, the time value portion of that option becomes profit at expiration, regardless of the price movement of the underlying stock. So basically, the time value portion of an option will turn into profit at option expiration when you're short an option. And let's look at an actual covered call trade I took recently. This is for AIG. I bought 900 shares of AIG at 29.7188. So I had a total of investment of $26,754. Now, the smaller accounts, if you were, you can trade a covered call with just 100 shares. So in a smaller account, you could do this trade if you had $2,600. So bought the 900 shares of AIG at 29.71. Then I sold 9 of the AIG 30 strike weekly calls at 42 cents or $42. So I collected, for that week, I collected $363 in cash income from selling those 9 options. So, of course, this $363 cash was credited to my brokerage account as soon as I sold these options. And here's the brokerage confirmation. It just shows I bought 900 shares of AIG, 29.71, and sold short the March 9th weekly options, the 30 strikes at 42 cents. So here's, I collected the $363. So, so again, the time value of an option turns into profit at option expiration when you're short. And the total investment to purchase those 900 shares of AIG was $26,754. Again, I had $363 that week credited to my brokerage account. So with AIG trading at 29.71, those 30 strike weekly calls would be considered at the money calls. So they consist of only time value. So that $363 of option premium was all time value, again, which becomes profit at option expiration if you're short that option. So now there's 3 possibilities for these covered calls each week. If at option expiration on Friday, if AIG stock increases in price at expiration, I still get to collect that $363 in time value. And if the stock goes up in price, I'll take a loss on the short option, but that's offset by the increase in the stock price in your account. But regardless, you still get to keep that $363 of time value. And if AIG stock remains flat, again, I still keep that $363 of time value profit. And if AIG stock declines, I still get to keep that time value portion of the option, but that could be offset by a loss in the stock. So the net return could be a loss that week if the stock goes down more than what I paid for or what I sold the option at. So let's say AIG stock declined $1. My loss would really be 58 cents because I sold that call for 42 cents. So, but then that Friday I get to sell another option. So even if the stock declines, every week I get to sell another option, and I still get to collect that time value, whether the stock goes up, remains flat, or declines, and you get to do that 52 weeks a year. So again, with weekly options, I get to sell calls against my stock 52 weeks a year. And let's just do a little math here on this particular trade I took. I collect $363 of time value. Now, if I was able to do that each week over a period of a year, if I sold 52 weekly options, that would be a total of $18,876 in time value profit. So if I divide this potential income that I collect every week by the total cost of the options of $26,754, I get a yearly return of 70.5%. So that's the potential from selling this weekly time value each week on this particular stock. That's the potential for the year would be 70.5%. So even if AIG stock declines 20%, I still have the potential to realize a 50% return. So every week I'm in there selling this option premium, whether the stock goes up or down, and I just collect that time premium every week. So that's what makes this such a great strategy. Now, when I roll over options, I get to compound my results, and I'll show you some actual examples of that here in a minute. So let's assume that I rolled over those AIG options every week, and I collected this $18,876 in time value profit. Each week, I can purchase additional shares of stock and do additional covered calls. So this would allow me to compound this $18,000 I receive, and then that could even increase this 70% return potential. So the compounding is a big part of the weekly option program. And here's a recent week. I took a snapshot of brokerage confirmations from 1 week where I sold weekly call options against my stock. And this particular week, the brokerage confirmation that it lists the amount of cash in this right-hand column here that's credited to your account when you sold the option. The first trade here was I sold 3 of the Apple February 18th 500 calls at $7.70, so I collected $2,999 in cash for selling those 3 options, and of course that was credited to my brokerage account. So that week I sold a total of $13,588 in option premium, and again that was all at the money options, so they consist of only time value. So that week I collected this $13,588 in time value, regardless of what happened to the price of the underlying stock. So this gives me the potential, if I roll these options over every week, that $13,588 in time value over the course of a year gives me the potential to collect $706,000 in time premium over the course of a year. So again, rolling over the weekly options allows us to reduce the transaction costs. The profit on expiring options allows us to purchase more shares of stock and sell more options and compound our returns. And that $706,000 in potential time premium profits I receive over the course of the next year, that would allow me to invest in into additional weekly covered call trades and compound my returns. So let's look at some actual rollover orders I used. And again, I like to use the spread orders because that reduces the transaction costs and allows me to realize even more profit each week because I'm only paying 1 brokerage commission, and I can split the price that I purchased the option and sell the option. I can usually split the difference in the time premium, and that also saves on transaction costs. So here's an actual rollover trade I took, weekly options. This was for Home Depot, and I bought to close the February 24th 47 strike calls, and then I sold to open the March 2nd 47 strike calls. So I was rolling over from the February 24th weeklies into the March 2nd weeklies with this option. And here's another example of a rollover. This is for Apple Computer, and here's another one for the Emerging Markets Index. And here's one more for the QQQ, the NASDAQ index. So in this one, I was buying to close the February 24th weekly option, the 63 strike, and selling to open the March 2nd 64 strike. So these are examples of actual rollover trades I took, and I use spread orders again to roll over options. Now let's take a look at the profit potential for weekly options versus monthly options. And I took a snapshot of an option chain for Apple, and when I took this snapshot, Apple was trading at 585.57. So the at-the-money call when the stock was trading at 585.57 would of course be the 585 strike. That's considered the at-the-money call. So you can see the quote for that 585 call for the March 23rd option was $14.05. So that's a weekly option because there's 7 days to expiration with this particular option when I took the snapshot. So if you were to sell the weekly option, the 585 call, and you sold it on the bid, you'd get $14.05 in premium, or $1,405. Now, let's contrast that to the April 21st option expiration. That's the monthly expiration, and there's 36 days to expiration on that. So over the same time period, you get to sell 5 of these weekly calls versus 1 monthly call. So if you were able to sell 5 weekly calls at $14.05, you'd collect over that 5-week period a total of 70 points of premium, $7,025, selling those weekly calls, versus 28.30 points of time premium for selling the monthly option. So that's a pretty big difference. So that's one of the reasons why I like to sell weekly options, because I have the potential to collect 70 points of premium over that 5 weeks as opposed to 28 points for a monthly option. So that's a big reason why weeklies provide a better return, because you're selling that premium every week. Here's another example for the emerging market index, trading at 44.09, weekly selling at 51 cents, monthly selling at 125. So with the weeklies, you get to collect over that same time period as the monthly, you get to collect 2.55 points of premium versus 1.25. So you get twice as much premium selling the weeklies. So let's look at, I have snapshots here of 2 of my brokerage accounts where I trade weekly options, and I currently have over $304,000 in actual open trade profits and a return of 33.8%. And this snapshot shows the stocks I own here, and then this was too big for one slide. So I took the bottom portion of that portfolio, which is the short options, and that's the short options associated with these stocks. And most of these are weekly options. So that's one portfolio. Here's my second portfolio, the stocks, and then of course the option portion of it. So altogether, with these 2 portfolios, I currently have $304,000 in actual profits and an average return of 33.8%. And these are mostly weekly options. Now, here's a snapshot of a year ago. This was March of 2011 when I was trading the weeklies. And in this portfolio, weekly covered calls, I had a $323,000 profit and an average return of 54.8%. So again, here's another example of weekly covered calls and rolling them over each week, which allows me to compound my returns, and that's why I get such a high rate of return. And here's one more snapshot. This is actually my 2009 trading contest. I competed in the international trading contest, and I was trading covered calls in this account. Here's a snapshot of that account, and these are covered call trades in here. I had about about $117,000 profit when I took this snapshot. And this lists the stocks and the short options here in the portfolio. And now that in 2009, I placed first in the contest, and I had an annual return of 122% trading these covered calls. And these accounts are audited before they're posted online, so there's no fudging the returns on these accounts. So
no cutting and pasting, right, Chuck?
No cutting and pasting. So that year I had 122% return, and that's posted on the website of the company that conducts the trading contest. So again, I traded covered calls in this account, and I rolled over these options. Now, these were monthly options back in 2009. I don't think they were trading weeklies at that point. So these are trading monthly options. So when I closed out a covered call, if the stock still looked good, I went ahead and rolled it over, and that allowed me to compound my returns, and that's how I wound up with a 122% return. So here's an interesting comparison, selling these weekly calls versus, let's say, buying CDs. According to the Bank Rate Monitor, today the national average return for a one-year CD is 0.34%, and for a five-year CD it's 1.14%. So let's just assume that you wanted to generate $50,000 of yearly income, and you were going to divide your money equally between, let's say, a one-year CD and a five-year CD. If you wanted to generate $50,000 of income, you'd have to make an investment of $6.7 million in the split evenly between a one-year and a five-year CD to generate $50,000 of income. Now, we saw where in 2009 I produced 122% in my contest account trading covered calls. In 2011 I had a 54.8% return, and currently, as of today, I have a 33.8% return. So let's just assume that you could generate 33.3% yearly return for selling weekly options, which I think is totally doable. That would only require a $150,000 account to generate $50,000 of yearly income. So you have $6.7 million investment versus $150,000. So it just shows you how lucrative these weekly options are when you get to sell option premium every week. And if you could get a 50% yearly return, it would only require a $100,000 account to generate yearly income of $50,000. So I just wanted to point that out as a comparison between fixed income investments right now and covered calls. So there's a very wide disparity in return between the two. And one last figure I want to throw at you. Over the past 3 years, I've generated over $5.7 million in cash income from selling option premium. So I have copies of my brokerage confirmations posted on my website, and these they list the call and the put options that I sold and the amount of cash that was credited to my brokerage account for each option sale. So that works out to more than $100,000 cash income per month selling option premium. So this is a great strategy. It's probably my main strategy that I like trading because I like the reward versus risk for this. It's a lower risk compared to other strategies, but you can see the returns have been pretty good. So that concludes my presentation, and I have a weekly option advisory service. So if you'd like to log on to the website and see the current trade results for the various portfolios, just log on to weeklyoptionalert.com, or if you're interested, you can call Brad toll free, and we can get you signed up for the service. So I want to thank everybody for attending today, and Tom, if we have any questions, I'd be glad to take them.
Yeah, the one main question that we have coming in from attendees right now, Chuck, is the liquidity aspect with weekly options. You find that most of the big name options that trade weeklies have decent liquidity?
Yes, that's a great question. I forgot to point that out when I was showing you the spread between the bid-ask price. You know, in the past, you could have a spread between the bid and an ask on an option as much as $1, $2, $3, $4. But with weekly options, they're very liquid, and you're talking spreads in pennies. You know, the spread could be 2 or 3 cents or 4 cents. So
Sure.
that's a great question, Tom. So
Sure.
they're very liquid, and especially the stocks I trade, and that spread is very, very, very small, just in pennies. So you're not going to lose a lot like you used to lose on the spread when you used to trade options. So these weeklies are really very, very liquid, very low transaction costs. So that's a great question.